In this free course, we are going to demonstrate the fundamentals of chart patterns for trading stocks, forex, cryptocurrencies, or pretty much any market you wish to trade through a price chart in this free video course. Since these patterns are universal, they are applicable to all markets and time frames. In this course, you will learn how to identify the patterns, the distinctions between reversal, continuation, and neutral patterns, as well as the differences between bullish and bearish patterns, and we'll also look at the logic behind each pattern and several trading strategies. Finally, we'll come to some conclusions about the usage of chart patterns and examine some of its benefits and drawbacks. This course is designed to show you the facts of using these patterns, which are typically purposely ignored from the outset by most trading educators. I'll admit that I'm not a fan of these patterns, but I want to make a resource so that people may learn about the advantages and disadvantages of these patterns. I think it's wise to become familiar with these patterns even if only to recognize their limitations. You should be aware that this video, like all the other content on my channel, is strictly intended for educational purposes before we get started. This is not financial guidance. You take your own risk when trading. So, let's start by discussing how to categorize the chart patterns. The classification of chart patterns functions quite similarly to that of candlestick patterns. In fact, there are two classification methods for the chart patterns, and they build upon one another. The chart patterns are categorized by direction and type, as we'll see in a second. Let's start by looking at the first category, which is the pattern's direction on the chart. The classification of direction relates to the direction that price should follow the pattern in. Given that we are discussing price charts, there are only two possible ways for price to go in after a pattern, either up or down. In addition to the direction classification, we also have a type of classification that builds on the first one. Reversal patterns, continuation patterns, and neutral patterns are the three different types of chart patterns. The type of classification describes what will happen to price in response to what was happening to price before the pattern. Let's analyze each of these three types separately. Reversal chart patterns indicate that price will move in the opposite direction after the pattern is formed. For example, if price is going up and a reversal chart pattern appears, price will decline according to the pattern. Of course, the opposite is also accurate. When the price is falling and reversal chart pattern appears, it indicates that the price will go up after pattern. The continuation chart pattern indicates that based on the pattern, price will keep moving in the same direction. For example, if price is rising and a continuation chart pattern shows up, price will likely keep rising following the pattern. However, if price is declining and a continuation chart pattern occurs, price is likely to keep declining after the pattern. Finally, we have the neutral classification for chart patterns, which indicates that depending on how the price breaks out of the pattern, it may go either up or down. These two forms of classifications are combined in the classification of chart patterns. For example, when we discuss a bullish reversal chart pattern, we are referring to a pattern that appears while price is declining in order to indicate an upside reversal. That's the case because the term bullish indicates what's going to happen after the pattern, which in this case is going up, and the term reversal means that price will change its direction after the pattern. If price will change direction after the pattern and it will go up, it necessarily means that it was going down before the pattern. In a bearish continuation pattern, the price will be falling and will keep falling after the pattern appears. In neutral patterns, we don't care about what's happening before the pattern. We simply take a look at which side price breaks out of the pattern, since that's the direction it will probably go. So, if you see a neutral pattern and price breaks out to the upside, the pattern is indicating that price will go up. If price breaks to the downside, the pattern is indicating that price will go down. If these classifications don't make much sense to you, they will become clearer as we walk through the examples of each pattern. Let's now move on to the study of the most relevant chart patterns one by one. We will begin by investigating each pattern in each classification, beginning with the reversal patterns. So, these are the patterns that, once confirmed, will indicate a change in price direction. The first chart pattern we'll look at is the well-known head and shoulders pattern. The head and shoulders pattern is a bearish reversal pattern, and it appears that price will rise before and after the pattern. A hidden shoulders pattern contains a few key components. We have the shoulders highlighted by numbers 1 and 5, the head highlighted by number 3, and the neckline highlighted by the line connecting numbers 2 and 4. This chart pattern gets its name because the price action resembles the shape of a head and shoulders, making it easier to remember and detect the pattern in real time. The logic behind the pattern is that price action will take a downward turn if a higher high in number 5 is not produced, implying that price will peak in number 3 in a failed attempt to surpass number 3 in number 5. All of this means that sellers are gaining power as buyers' energy runs out. The neckline is the most important thing to consider when trading a head and shoulders. This is the line you'll see when price action breaks out of the pattern, confirming it. It is also the line that will indicate where you should enter the market. Allowing price to break below the neckline and then waiting for price to return and retest this line is the best way to trade a head and shoulders pattern. Some people try to enter a short trade as soon as price breaks through the neckline, but the problem with that is that you may end up entering at a much less precise point, resulting in more risk and a lower potential return. As previously stated, the ideal situation is to wait for price to retrace back up to the neckline, and as price approaches the neckline, it is also important to look for signs that price is indeed respecting the neckline as resistance. For example, if price returns to the neckline and creates some sort of bearish reversal candlestick pattern as it approaches it, you might consider going short. This is merely one example. Of course, if price returns to the neckline to retest it, thousands of different things can happen. In conclusion, there are primarily two ways to enter a trade using a hat and shoulders pattern. You can wait for the price to close below the neckline and then use that to trigger a trade at market, which is a riskier entry. You can also wait for price to close below the neckline before returning to retest it. Observe how price reacts as it approaches the neckline. Be aware that it is entirely possible that the price will close below the neckline and then begin to rise again, ignoring the neckline completely. That is why it is critical to enter in the most precise location possible, as it will be less risky after the entry. You'll also need a logical stop loss and a logical target, which will vary depending on the type of entry you choose. The logical stop-loss order is above high number 5 because as price breaks down the neckline, high number 5 becomes a confirmed supply zone or a point where sellers confirm their power. If you're unfamiliar with supply and demand trading, watch the Ultimate Beginner's Guide to Supply and Demand Trading on YouTube. This is the most secure stop-loss in a head and shoulders. Now you can see why waiting for the price to retrace to the neckline is a better idea. Because it will reduce the size of your stop. You can also put your stop above high number 3. As your stop loss size increases, your take profit target will have to increase proportionately as well. And the larger your take profit, the less likely it will be hit. The general rule for the take profit target is that it should be at least 3 times the size of your stop, which means you must have the discipline to let the price hit either the stop or the target. You cannot close the trade as soon as price goes into profit, as this will damage your account in the long run. Some people talk about measuring movements to create targets, but that makes no sense to me. Another feature of the head and shoulders pattern is that the neckline is not always horizontal. It can be sloped up or down at times. You must be cautious when this occurs because you want to place your stop-loss order above highs that confirm the power of salaries, meaning highs that precede lower lows. The reverse hidden shoulders pattern works similarly to the standard hidden shoulders pattern, but the reverse version is a bullish reversal pattern, whereas the standard version is a bearish reversal pattern. The reverse head and shoulders pattern has the same configuration as the standard, but the pattern is reversed. We have a lower low is followed by a higher low. The reasoning is that sellers were able to make a low in number 3, but when they attempted to make a lower low in number 5, they failed. Price breaks above the neckline, which, as previously stated, can be horizontal or sloped depending on where the previous highs and lows are located. Price retraces back to the neckline after breaking above it, and the optimal and logical stop-loss order is below number 5. That is because if the price breaks above the neckline, number 5 will become a confirmed demand zone, which will usually protect your stop-loss order. Not always, however. This confirmation of the demand zone may not occur if we are dealing with a reverse head and shoulders with an excessively steep down-sloping neckline. The trade's target must be at least 3 times larger than the stop. If you want to survive trading in the long run, you must maintain a risk-reward ratio like that, but that is a topic for another course. This is the end of part 1. I hope you like it. Thanks for watching. Don't forget to like, subscribe and ring the bell to get notified for part 2. See you in the next one.